Hi everyone, today I want to talk to you for a few minutes about journalizing, the process of recording our everyday transactions in our general journal. I'm going to start this video assuming that you have already memorized your debit and credit rules. So you know that an asset is increased by a debit. You know that capital is increased by a credit. You know that liabilities are increased by a credit, etc. So we're just going to start with the actual journalizing part. If you have not memorized those rules, please memorize them ASAP so that you won't just be guessing. Using them is easier once you memorize them. And then believe me, we will use them so much it will just become second nature. So when we are journalizing our transactions, we are basically taking everything that we did in chapter 1 and we are taking it one step further. For example, let's take a basic transaction. Let's see. Purchased supplies for cash. Let's say, y'all don't make fun of my typing now. $1,500. Okay, so this can be our first transaction. If we purchased supplies, then we know that supplies is going to go up, correct? Because we now have more supplies. We know that from chapter 1. So now all we need to do is add the debit or credit portion to this. If supplies are going up, we want to increase the balance of our supplies account. Supplies is what type of account? It's an asset, right? Because it has value. How do you increase an asset? Debit. Very good. So we would record our date over here. We'll just say that it is May the 3rd. Just making this up, obviously, right? And we are going to record our account title, supplies. We're going to debit it for $1,500. So by doing this, I am increasing the supplies account by $1,500. The second part of the transaction, we purchase supplies for cash. Okay, that means I spent money, right? If I spend money, the balance of my cash account is going down. Cash is an asset. So if we want to decrease an asset, is that a debit or a credit? Credit. Very good. So I'm going to come down here on the next line. We always indent our credit. So I'm going to go cash, and I'm going to come to the credit column, $1,500. And this is how we would record our journal entry. So we're basically taking the same information we had in chapter 1, the same thought process, and adding one more question. Does that make sense? Now let's talk about some basics about recording journal entries now that we've done an example. The date column, you're going to put the date. The account titles, your debit always goes first. Your credit accounts always come second, and your credits are always indented. Your debit numbers go in the debit column. Your credit numbers go in the credit column. This column, PR, stands for posting reference. We're not going to talk about posting in this video, but we are learning about posting in chapter 2. Posting is just taking your information from the journal and putting it into the ledger. The ledger is where we keep like a specific page for each account. So a page where we keep up with all the cash transactions, a page for accounts receivable, a page for supplies, kind of like you have a ledger for your checkbook. So you keep up with a running balance for your checking account. We're going to do that similar thing for every one of our accounts. So posting is taking information from our journal and putting it into our ledger. Okay, and we'll talk about that at some point later. We can have multiple debits and multiple credits. So I could have debit, debit, oops, didn't mean to do a capital E there, but no big deal. Whoops, debit. We could have 3 debits and 2 credits. Remember how in chapter 1 we learned about the accounting equation and how it always had to be in balance? Well, our debit and credit rules are simply a series of pluses and minuses that work together to keep that accounting equation in balance. So if we want the accounting equation to always be in balance, then debit and credits have to always equal. And I'm sorry, I can't leave that like that because I'm just too OCD. Okay, so if we were going to have 3 debits and 2 credits, that's fine, but these numbers have to equal. So if this is 100, 100, and 200, then my total debits are 400. So maybe I have 2 credits that are 200 apiece. I could have 36 debits and 17 credits. I could have 1 debit and 5 credits. Does not matter as long as total debits equals total credits. Just like our numbers for every transaction equaled in chapter 1, they will equal in chapter 2 when we are journalizing. Hopefully that makes sense. If not, let me know. Okay. So I'm going to clear these out and we're going to do some more examples so you can kind of get this thought process in your head. Let's say that we performed services for clients and received cash $3,200. If we performed services and received cash, that means that we are getting paid. If we received cash, the balance of our cash account goes up, right? If we want to increase cash, cash is an asset. How do you increase an asset? Debit. Very good. So I'm going to debit cash, 3,200. If we performed services, doing whatever it is we're in business to do, that means that we earned revenue. I'm earning more revenue, so the balance of my revenue account is increasing. How do I increase a revenue account? Credit. Now remember, in chapter 2, we are naming our revenues and expenses. So depending on what the problem tells you, we could use fees earned, we could use services revenue, we could use consulting fees revenue, consulting services revenue, any revenue account that makes sense for our business. And it would be 3,200 also. That makes sense? Okay. I know, I always say, does that make sense? That's what I say in class. Hopefully if it makes sense to y'all. I know you can't speak back to me right now, but jot down a little note. Let me know if it doesn't. Let's do another one. Let's say that we purchased equipment, paid $5,000 cash, issued note payable for remainder. Okay. Oh, so I need to give you a value here for equipment, don't I? Let's see. Purchased equipment, $25,000. Paid $5,000 cash, issued note payable for remainder. So this is like we put a down payment and we're going to finance the rest. We put a little bit of money down and we went into debt for the remainder. Bought the rest of it on credit. If we purchased equipment, then we're getting more equipment, right? So the balance in our equipment account is going up. Equipment is an asset. If we want to increase our asset, what do? Debit. So I'm going to debit equipment. What is the cost of the equipment? Notice I said cost because we record everything at cost, correct? Cost is $25,000. Not the cash I paid, not the amount I'm going to issue the note for, but the total cost of the equipment is $25,000. We paid $5,000 cash. That means our cash is going down by $5,000. How do we decrease cash? Credit. Very good. So I'm going to credit cash $5,000. Now I know I can't leave this entry like this because my debits and credits don't equal. And that's not the rest of what happened. Issued note payable for remainder. If I issued a note payable, that means I've got to pay it later, right? I purchased the rest on credit. That's a liability, isn't it? If I bought more equipment on credit, the balance of my note payable is going up. How do we increase a liability? Credit. So I'm going to credit note payable. What is the remainder? 25,000 minus 5 gives me 20,000. Now my debits and my credits are equal. I've got a debit for 25,000 and my two credits add up to 25,000. So this is what I mean about having more than one debit or more than one credit. I didn't put a date on this one, doesn't matter, let's just say the 8th. So hopefully this is making sense and helping you. If you were caught up and doing well in Chapter 1, analyzing those transactions, remember we are just adding this step. Was it going up? Was it decreasing? Well, if you know what kind of an account it is and you've memorized those rules, then you just know, well, if cash was going up, cash is an asset, so I need to debit it to increase it. So it's just a matter of combining. Remember, these first 4 chapters really build on each other. The thought process from one chapter carries on to the next. So it's very important to stay caught up. Let me see if there's anything else I want to tell you. Oh, just to make sure in case we haven't mentioned notes payable before this point, the difference between accounts payable and notes payable. An account is something that we are normally going to pay off within a year, short term, and different people can classify it a little bit differently. But note payable is typically going to be something that we're going to pay off over long term, like we bought expensive equipment or building or vehicle, something you're going to pay maybe in monthly installments or over, a longer period of time. Typically, you won't have to decide. Typically, if it's going to be a note, the transaction will say something to the regard of issued a note for the remainder. It'll kind of use the word note to let you know. But it's just like accounts payable. It is a liability. It represents debt. Let me know if you have any problems. Make sure you are recording in the proper format. Debits always come first. Credits always come second. Make sure you're putting your debit numbers here and your credit numbers in the credit column. Hope this is helpful. Let me know if you have any questions.